clients like there's no tomorrow.
Hello, welcome everyone to lecture number 13. Today we'll be talking about value at risk, historical value at risk, value at risk based on Monte Carlo, and also expected shortfall. Today we'll be becoming a little bit of a risk managers. We'll be talking about how to diversify your portfolio to manage your value at risk. Let's take a look at the content of today's lecture. I have prepared two blocks today. So the first part will be mainly based on motivations for VAR calculations and how VAR calculations are related to the risks in your P&L, on your forecasted value of your P&L. The VAR calculations and also the stressed VAR, so the VAR that is used in a stressed scenario, typically this scenario is associated with a crisis period like in 2008, 2009. So those are two different measures of value at risks. Those will be confronted against expected shortfall. And I will put also those two measures, I will put in the context of coherent risk measures. So those are the measures that define what are the, let's say, measures that good risk measures should satisfy. I will also explain that the value at risk actually it doesn't satisfy one of those measures, but I'll also explain why it is still considered to be a good measure and in industry it is well accepted. This is the first block. In second block, we are doing more programming, so be more hands-on exercise. We will start with a simulation of a VAR, value at risk. So first we will build a portfolio consisting of multiple interest rate products. Then we will download market data for yield curve, so yield from the Treasury Department. And then we will calculate shocks, so historical shocks. And then we will revalue our portfolio for VAR. So we calculate VAR on our portfolio. That will be a little bit involved compared to what we have seen before, because in this exercise, it would require that we need to recalibrate yield curve for every scenario. So I will show you how to do that in another efficient manner. Then we will have some practical issues like missing data, arbitrage, and regridding of a yield curve. So this is more on the handling of this real scenario when the data, market data you see, they are not ideal. Then there is another concept of VAR calculations related to Monte Carlo. Here we'll be talking about Monte Carlo simulation of the risk factor that we use for VAR calculations. Here we also discuss concepts of calibrating your stochastic differential equation to either historical data or, for example, market data available today. And that is related to calibrating to under P or under Q measure. And those two also can be used to calculate your VAR. Of course, you see we have many different VARs. And as a risk manager, you should never choose just one specific measure for making decisions regarding your portfolio, but you should look always at multiple of them. So we have a value at risk, historical value, stress value, we have expected shortfall, we have a Monte Carlo based value, and of course, all of them, they have some added value and they are slightly different. So of course, it's good to take a look at all of them and then decide whether your portfolio is healthy and is, let's say, resistant against some kind of market crashes. We will finish with the idea of a backtesting, so how to test your VAR algorithm, whether your portfolio doesn't miss any risk factors. So I'm not going to give you too much detail on, let's say, on backtesting, because there's a lot of literature how to test your models. We will concentrate today more on the implementation side, how to handle your portfolio, how to generate scenarios, how to recalibrate yield curves, and how to revalue your portfolio and calculate expected shortfalls and different types of VARs. We'll finalize with a summary, and also there will be an assignment where you have to extend some Python code in order to calculate VAR for a specific portfolio consisting of stocks and also interest rates. So this assignment will be also a little bit of being a risk manager. Here also you will need to think of how to diversify your portfolio to manage your risks. So I think that it's a very nice lecture. We have some theoretical aspects, we have also some programming and also nice assignments. I hope you will enjoy it. In the previous lecture, we have discussed the calculations of SVaR that was made based on simulation of exposures of our portfolio. So how it worked? So we had, let's draw here possible scenarios. So we had here time, we had a risk factor, and for every, so these are possible scenarios of our risk factors. For every scenario, we had to calculate value of our portfolio. This was basically those, let's say here we have 4 paths, so 4 times we had to calculate value of a portfolio. This, of course, if we have multiple paths, then we could have a distribution of our value of the portfolio given possible scenarios at time here will be ti. Let's take this density here on the right hand side now. So we have this density of our value of the portfolio, and then we were able to calculate, for example, potential future exposure, which was associated with this quantile here, and that was essentially a point where the probability of the values of our portfolio, so the distribution was 95% of confidence level was this level, so we had some potential future losses which were on that side. This point X indicated where's the point where we had the losses will not exceed, or actually may exceed, but we have 95% confidence that the losses will be below that point. Of course, this also meant that our value of our portfolio, of our exposures, will be much bigger than this point X. And today we will see that calculation of value at risk is very similar to what we have learned before in the terms of XVA. So this is also, you can think of kind of additional way of looking at your portfolio. Before we were looking at the exposures, so values of your portfolio in time. Today we will have a little bit slightly different situation because we'll be looking at the portfolio at time t0, so today's portfolio, today's market data. However, what we'll be looking at the, let's say, possible changes of the risk factors in a given window of time. So basically the idea of value at risk of all those measures that we'll be discussing today is that what is possible distribution of the P&L or profit and loss from our portfolio if we would keep this portfolio unfixed or fixed over the period of 1 day or 10 days. So essentially, we are not really evaluating the different values of the on the paths that we have, but we'll be looking at the portfolio and then we'll be evaluating some kind of scenarios. So possible, given the market scenarios, either historical data or simulated from Monte Carlo, we'll be looking for the possible market movements in a given period of time, and those movements will be included in today's value of the portfolio. So you will see it will be maybe sounds a little bit technical right now, but you will see it's very much similar to what we have done before in the calculations of exposures, expected exposures, and potential future exposures. So you will see that will be very much related. So if you have mastered the subject from the previous lecture, you'll be on a well track to really understand the valuation of value at risk, historical value, and also stress value, and of course the expected shortfall very easily without so much problem. So okay, the value at risk is a market risk measure. It measures potential losses associated with market fluctuations. So before in potential future exposures, we were looking at the potential exposures. Here we are looking at potential losses. Of course, from a risk management perspective, you would like to know what is the possible losses if market suddenly would move, or let's say if it move as it was moving in, let's say, last year, in what is the worst case scenario, what is the possible profile of your P&L for tomorrow. This will be basically something that you, as risk management, you would like to have. You don't want to be in a position that every day you try to guess where the portfolio most likely will be or how much will be worth. You would like to get some kind of measure. What is the distribution of your P&L, of your profit, of your or value of your portfolio for tomorrow? So VAR, essentially, this is very much stressed, tries to provide a single number that would answer the following question: how much I can lose at most on this investment in a given period of time. And it's very important to stress that this is not really answer that is provided by VAR. VAR only tries to answer this question. You will see actually in this even slide that this is not really the answer that VAR provides. But this will be discussed in a few minutes. From a regulatory perspective, central banks require that every bank keeps enough capital to cover potential losses estimated based on VAR methodology. So if you have VAR calculate, you have calculated that potentially you may have some significant losses, then you have to gain capital to make sure that you will be still, let's say, in the business, you exist as a financial institution. So this perspective of, let's say, VAR, it is very important because this gives you, even if you have large portfolio and market moves, you are already prepared for that because you were looking at the worst case scenario, let's say, of some historical data or of impossible scenarios that could happen, and then you have enough capital to sustain your business. So this is how VAR typically would be used. Of course, this is attempt because if you have a portfolio, then obviously a regulator will like financial institutions to survive, let's say, a crisis, some recession, or market sell-off. Of course, the question will be, what should they introduce, what kind of measures that indeed financial institutions will exist over a period, let's say, of 10 days. And this is one of the attempts. So VAR is a methodology which is imposed by regulators on keeping an eye on better monitoring of your positions and risks, such that you can actually handle the periods of market dramatic moves. And of course, if VAR indicates that you have losses that may be substantial, then you have to really maybe acquire extra capital from investors. And that will be the way to manage your portfolio and potential losses. Let's take a look now at the definition of VAR. So VAR is very much related to what we have seen already before for potential future exposures, is the infimum x belonging to real numbers. And then we have a condition here that the CDF of x is bigger or equal to alpha. So essentially, if we think of x to be our profit and loss of our portfolio, so let's look at the distribution. This will be here. We have a distribution, profit and loss. Of course, it could be positive, could be negative. Of course, we would like to be, we would like to be more on the positive side. So this is profit and loss. And then we are, and our x, this is equal to our x. So we are looking for alpha such that the CDF will be bigger, the CDF at this point x, that is infimum, bigger than this alpha. So essentially, if we have this alpha here, let's say 5%, that the CDF of at this point, so essentially this probability here, mass, the integrated probability here would be, let's say 95% here. We have a 5% on this side. 5%. So this would be our, if we have a profile of profit and loss, this will be our VAR number. So this will be x here corresponding to exactly this point. As an example, so if we have this 95 one-day VAR, in a minute I will explain you what that means, one-day VAR is 1 million, then there is a 95% confidence that over next day the portfolio won't lose more than 1 million. So basically this is the point, this is how it's interpretation of the VAR number. Of course, this is very important, won't lose more than, and this, so there is 95% confidence that you won't lose more than, but it could be, of course, that there is a, for example, if this distribution, let's say, goes here, that there are also some events here. So it could be, for example, that you may also lose much more than 1 million, but probability of that event is very low. So this is something to keep in mind, that if you have a fat tail event, so something that you didn't expect, that indeed that could be, for example, destroying your company. However, we are looking at the 95% confidence that you will not lose more than 1 million in this within 1 day. So regarding this 1 day, how it is estimated, basically what you would do, you would look at the portfolio that you currently have. You would look at what are the maximum, or let's say all the market movements within 1 day. So suppose you have a stock that you observe in time. So let me take a look, illustrate how this would work. So suppose you have a stock historical data. We are here today. This is T0. So this is past here. And the stock moved as follows. So we are here at this point here. So of course, if we like to calculate the value of a portfolio and then there's a stock, of course, we will not use this data as such because historical movement of the stock will not really help us to predict the future. But what we can do, if we cut this interval into pieces, if we divide this interval into pieces, we can look at the daily fluctuations. So for example, this was daily move, this was daily move, and so on. So essentially, for example, you could have daily move here this much, this move will be here, here, for example, could be, of course, I'm looking also, it could be negative, positive, right? So you have a whole distribution of daily moves. Does this mean that if you are in this point, you can apply those daily moves, and essentially you will get distributions of possible daily moves that your stock could be worth tomorrow. So this is basically the idea. You look at historically how your underlying asset was moving day to day. You're not looking at the absolute value, but only at the differences. And then you apply those differences to today's value of underlying. And given that value, let's say with the increment of the changes, then you have basically you have to reevaluate your portfolio, and then you will get this distribution of your profits and losses. So this is in short. Later I will explain in more detail how it goes. But basically you are observing daily fluctuations, and then those daily fluctuations you would apply to today's value. So you see, this is much different than what we were doing in exposure calculations, because we were just looking at the absolute value of your risk factor. So if risk factor was here, it didn't have anything to do with the risk factor value time t0. We were just looking at this value here, and then we were evaluating portfolio. In VAR calculation, we are looking at the value at this point. However, we're only applying the change from day before. So if this was Tn, we're only looking at this difference between these two dates. And this difference would be applied at the risk factor today. So it is, you can actually think it's much simpler what we have done in the calculations of expected exposures. Because here we really were performing, let's say we had this, maybe remember, a lot of discussions regarding filtrations, what are the observables, what is measurable, and so on. And that basically, it sounds much more complicated than just taking today's portfolio and evaluating multiple times, given some historical shocks. And this is actually true. VAR calculations in the market practice, also in the industry, has much longer history than expected exposures and XVA. It exists more than 40 years right now. XVA, it is, let's say, well accepted industry after the great financial crisis. So you see there is of course, you can say this was the beginner or the initiation for this expected exposures idea. Now we have, of course, more technological advances. We can also perform those calculations much better. In the past, this was essentially the idea of the VAR calculations, that we kind of try to impose, let's say, what was historically the distributions for your movements of the underlying, and apply that to today's value of the underlying asset that you have. Later, I'll also explain that this is not only one way to do that. You can also do some parameterizations. You can do Monte Carlo simulation. There's a lot of different approaches you can handle these calculations of VAR. But this is just to give you a flavor what VAR tries to achieve, how it achieves, and what are the possible limitations of this approach. So, a few important points regarding VAR. So, depending on portfolio composition, market data used in quantile level, VAR measures overall risks associated with market movements. So this is what we actually want to see. We want to see, let's say, one number that represents all sorts of risks associated with the historical market movement, or even hypothetical market movements, as I will explain you later, and then represent our risk of the portfolio given that a single number. Of course, that's always easy. If you can compare two numbers, then you know where you have more or less risks. VAR approach is very attractive because it's easy to understand. So as I have explained you the whole VAR methodology essentially in one slide, just the previous slide. So I'm pretty sure you understand, especially after the previous lecture, what is the main idea. So you see, from the regulatory perspective, it is also easy to explain to all the financial institutions. Sometimes they're very small, sometimes they're advanced and very modern. But this way of measuring risks, you can easily control, and you can really have a good feeling what are let's say, the potential losses for the bank, or where is the VAR for each company, and whether company can sustain their business. Of course, if you are satisfying the VAR requirements, it doesn't really mean that you are prudent. Yeah? So this doesn't mean that you will always survive if something bad happens, because, for example, those tail risks. However, VAR would be one of those measures that you would be monitoring to see what overall financial situation of your financial institutions. VaR provides an estimate of the amount of capital needed to support a certain level of risk. So this is also important. So if you observe your VaR, you know, for example, how much money you have necessary to support your, let's say, given risk appetite, how much money you need to extra provide to reduce that, for example, the capital risk. So, for example, here, if we have this distribution and those losses are not accepted by us, because risk management says this is definitely too much. So this part that we have losses actually on this side, it is not accepted by our financial institution. If you would add capital to your portfolio, essentially what you would do, you would move this distribution to the right-hand side. So you would be moving this whole density on the right-hand side, and then this quantile will be, for example, much closer to zero. For example, even positive, you could say, in the worst case scenario, let's say you have 95% confidence that next day portfolio won't lose any money, actually it could gain money. This is also a possibility. So if you would add extra capital, we move then this whole distribution to the right-hand side. So of course, this is also indicative for risk management, how much risks, for what level of risk, how much capital you need to add to your portfolio, or you can, for example, even subtract. If, for example, your portfolio is very secured, maybe you can add some, let's say, more risky derivatives to benefits in some sense of it. Another advantage of the VaR measure is the ability, of course, to some extent, to incorporate effects of portfolio diversification. The portfolio diversification under VaR, it's a little bit problematic, and I will explain you in the next block when I'll be talking about coherent measures. So VaR is not ideal. However, to some extent, it allows you to observe the diversification effects. Later, I will show you exactly what the problem is with this point. In general, it is really helpful. However, there are some cases where you could say that diversification under VaR measure will not really be shown by VaR. So that's VaR can actually increase even if you try to diversify. That's also a possibility under this measure. So this is not, of course, ideal. But there are also improvements, like, for example, expected shortfalls that I will also discuss in this course. The model parameters are standardized for capital requirement. For capital requirement purposes, and require banks to use one-sided confidence interval of 99%. So once regulator steps in and introduces as the requirement for the banks, financial institutions, of implementing VaR measures, of course, banks also the confidence interval or confidence level is also imposed by the regulator. So obviously, if a regulator would say apply VaR and the most important parameter of the confidence level is not specified, that will be open to interpretation, because every financial institution will choose the level such that is the most suitable for them to show that they have their conservative with respect to risk handling. So this is, of course, a requirement from the banks. Of course, 1% you can say it is also conservative, but it's also it's a little bit, maybe it's conservative. However, the tail risk of events that they are, let's say, not really let's say expected to happen, or if the market starts to move dramatically, obviously this 1% it could lead to substantial financial losses. And of course, VaR calculations, if you rely only, let's say, on a moving window of 100 days, or let's say 1 year, so 250 working days, because this is essentially what VaR does. VaR evaluates portfolio given market scenarios over last year. Of course, you can also use some kind of stress scenarios and so on. If last year was very quiet, that could be also misleading regarding your risk profiles. But for that reason, you also have to look some additional measures, and I will explain them in the next slides. Regulators often require a holding period of 10 days. So this means that, you remember here, we were looking at the movements of stocks over 1 day. So we're looking at if stock moved from 20 to 30, let's say from 20 to 21, this means 1 is the increment that our stock can move today. From here, stock moved down. So this means, okay, over 1 day, we can also decrease this amount. 10 days essentially means that we are measuring the evaluation, how stock behaved over 10 days. So for example, if stock moved in 10 days 5%, this means our point will be here 5% lower. If it moved 10% up, then it's here. If it's, for example, main stock, it moved 500%, then of course we could say even here. So this depends. So the window that we have, of course, longer the window that we observe the scenarios, the longer the window when we observe the movement from today to value in 10 days, of course, because there is a time effect, of course, that will have an impact on the distribution here. So we could have if it's 1 day, we could say this is this distribution. If it's 10 days, it's a much wider distribution, and then so on. So of course, that would, bigger the distribution or larger the time period that you have to hold your portfolio and calculate your and keep your losses. Of course, larger than the time window, the wider distribution would be for your P&L distribution. And of course, regulator requires that you need to have 10-day holding period. Is that if there is a market turmoil and you are not able to reduce your position, market or regulator requires that you'll be able at least to keep your position over 10 days. Because, and not only keep your position, but you'll be still within the acceptable risk levels within 10 days. And after 10 days, typically market stabilizes. Maybe you'll be able to unwind your position, so sell off some of those positions to reduce the risks. So regulators require 10 days and at least 1 year of historical data for market risk factors. So this means that we are going 1 year back and we are observing the historical evolutions of risk factors. And then those, let's say, 10-day increments or 10-day movements from day 1 to day 2, day 2 to day 3, or actually this will be 10 days. So 1 day to 10 day, 10 day to 20 here, 20 day, those increments would apply to, let's say, to today's value of stock, and then you have to go 1 year back. Also, there is some kind of stress scenario. So regulator often imposes that you're not only looking at the previous year, but also you're looking at the scenarios from the stressed period. That's called SVaR. And then this means that you'll be looking at the periods. So you'll be applying this 10-day window, but you'll be looking at the market data, let's say from 2008 until 2009. So maybe 1 year of a very violent, volatile period of time. And of course, that will be also indicative of your portfolio, whether your portfolio will be able to handle kind of a crisis we have experienced in the past. Of course, it doesn't really tell you whether you'll be able to survive next crisis. However, it prepares you to some extent. Your immune system will improve if you are able to survive the previous crisis. More likely you'll be able to survive next crisis. And of course, if you have failed on a stress scenario, this means that it's less likely you will survive next financial crisis. Although the model parameters are standardized, banks do not have to a particular approach. So banks don't need to follow exactly the particular approach of our estimate. So you could think VAR is just this is just one equation you always have to follow. However, there are many different things that you can think of. For example, how to handle missing data. What if a market has changed and some quotes were introduced meanwhile? So those kind of very specific choices, also regarding interpolations. So how, for example, if you have a yield curve, what kind of interpolation would you apply on the yield curve? What if you have missing data and you want to regenerate missing data? So those are more open issues, so let's say open topics and the subjects that banks may specify themselves. Of course, banks and financial institutions will need to write everything out. It has to be very much regulated, so everything has to be specified, and also regulator has to approve whether the methodology chosen by any bank is satisfactory or is it good enough to be respected as the valid measure of your value of risk. And you see some typo here in the sentence. I will improve that in the final version of those slides. Okay, there are four main methodologies regarding calculations of VAR. So the first one is the one that definitely we are not going to follow in this course, is so-called parametric VAR. And this means that we impose some kind of distributions over the returns of our risk factors. So for example, in this case, maybe often it looks like I'm plotting here normal distribution also here, but in reality those distributions may not be normal, and especially if you have shocks, you have stress scenarios, those returns will not be normal. So parametric form, it is basically imposing some structure of your returns, and then using those distributions, you can, let's say, sample from the potential increments of your, let's say, 10-day or 1-day window, and then you can apply samples from them to evaluate your portfolio. However, you see this is, I would say this is heavily biased, because first of all, you need to really understand the risk factor to be able to claim that there is any distribution. On the other hand, distributions typically have a tendency of changing in time, and if the distribution doesn't have a properly chosen fat tail of events that are very unlikely to happen, then it's also, you can be handling or exposing yourself to a huge amount of risks if your distribution is not properly calibrated, or it's even not suited sometimes to a particular risk factor. So especially if you talk about a stress scenario, market crashes, some strange things happen in the market. If you have made assumptions about, let's say, normality, this will be never exposed in this methodology. So you have to be very careful. But this is not approach I would recommend. Then we have three others. So the last ones are very similar to. Also, I have mentioned something about them, and there is one that I would like to start with. So, of course, Monte Carlo simulation. So here is this very interesting case, because Monte Carlo simulation, we can think of two ways. We simulate, of course, our risk factors like we have done for calculating of exposures using Monte Carlo. And then we are looking not at the evaluations. So if you go back here, we are not evaluating our portfolio, let's say, on this particular path, but we, again, like here, we'll be looking at the daily movements, so only the increments of changes of a risk factor, and then we will be applying it to today's value of a risk factor. So in this case, we'll have basically R0, this will be, let's say, initial interest rate, and then we'll be adding here, let's say, delta Ri. This delta Ri will be changed in our R over, this R will be, for example, here, let's find the Ri would be R time Ti plus 1. Sorry, let me fix this. Minus RT. So this is how we can fix. So we have a delta of Ri, and then we apply this whole changes for all those paths to today, of course, and then we have to evaluate, of course, depending on number of paths, this new risk factor and evaluate our portfolio. So this is the way of Monte Carlo. What is interesting here is actually this Monte Carlo case is that you can do it in two ways. First, you can simulate your Monte Carlo using risk-neutral methodology. So for example, you say, I'm calibrating my model to market implied volatilities from couplets, swaptions, and so on. And then you have your, let's say, calibrated parameters. Then you evaluate your paths. And then you can think of a VAR, which is calculated based on the risk-neutral valuation, because your measures of risk of your portfolio will be evaluated under the Q measure. Of course, there is a tweak because you're still, let's say, applying those shocks to initial. So this is not necessarily as the same as pricing, because you're basically taking the increments and apply it to today's value. On the other hand, what you could do, you can also calibrate your Monte Carlo models or stochastic differential equations to historical data using, for example, some paths from the past. And then you can also simulate VAR based on historical data without actually doing what we have done, discussing this historical VAR. So you calculate increments based on paths, not on the observable quantities in the past, like, for example, LIBOR rates that they were available in the market in the past. And then we are going to this, indeed, the market. Also, we have two cases. HVAR, so historical data. So we have this running window, let's say 250 last business days. For each of those days, we see a risk factor, for example, stock or LIBOR rate, and we monitor the differences, let's say, of daily, day-to-day fluctuations or every 10 days fluctuations. And then we apply to today's risk factor, and then we reevaluate our portfolio. And then a slightly different variant is that we have a moving window. Of course, we have a window of those market shocks or observables. But this one is moving window, so it always goes in time with us. So it's always, if we are if we are here, we always have, let's say, this window, 250 days. If we are here, we still have this window, 250 days. If we are this point, we have this 150 days. And stress var will be always, for example, always this period here. Even if we are here, or we are here, or here, we will be always looking at the window of observations. So let's say the var historical data that's going to be used to estimate our var, it's always given in some stressed period where, for example, there was a crisis. And this is why it's called SVaR. When applying any risk measure to your P&L or your portfolio, it is important to know whether the risk measure you have applied is it good measure or it's not. In the academic world, number of requirements have been proposed such that the measure is considered to be good. It's often called coherent measures or coherent risk measures. And this is the topic of this blog. I would like to, before we go into details, mention that there is a lot of also criticism regarding, let's say, from practitioners about the requirements of coherent risk measures. Often practitioners claim that although some measures are coherent, they are very difficult, for example, to be used in practice. They may not satisfy the backtesting requirements, or, for example, they are really, let's say, even if a measure is not coherent because some condition is not well satisfied, it does not mean that it's a really bad measure. It could be that the lack of coherence of the measure, it is only not satisfied in very extreme scenario. And this is example of VAR. VAR measure is not coherent measure because it's not subadditive. And I will explain in a minute what that means. However, in practitioners still tend to think that VAR as a measure is good measure for the risk management. Of course, something, if it's not ideal, it doesn't mean that should be immediately rejected. It still can serve you a purpose of for your monitoring of your risks. So as such, it can be used. However, you should not solely depend on that particular measure. You should also have other types of measures as a risk manager. And then if you have a portfolio of different measures, that would give you better feeling about your risk profile and also confront against your risk appetite as the risk manager. So I would say be always conscious about the risk measures you're looking at. Never specify a single measure to assess the risks associated with your portfolio, and always look from maybe so-called helicopter view. Take multiple risk measures into account, and then in that way you'll be a good risk manager. You have a better understanding also of the whole, let's say, the portfolio composition that you have. So there are few requirements for a risk measure to be coherent. The first one is so-called sub-additivity. So this is raw here is this measure we are looking at, and this is kind of interesting. So if we have a X and Y, so let's say we have two assets and we have a risk associated with a sum of them, then we'd expect that the risk measure of some of them is less or equal as the sum of individual risk measures of those assets. So sub-additivity ensures that the portfolio diversification principle holds, since a sub-additive measure would always generate a lower risk measure for diversified portfolio. Because of course, if we add some stock here, this means, depending on the correlation, we could diversify our portfolio so that measure should be less or equal to the sum of different measures. And this is the condition actually that is not satisfied by the VAR. And of course, there are a lot of articles written that theoretically you can actually find cases where VAR it's not satisfying this condition, and this typically had to do with some extreme events examples. However, in practice, this is most of the cases it is actually satisfied. So although theoretically VAR doesn't satisfy because of some extreme scenarios, in most cases, in practical cases, it is satisfying this condition. But this is good to know. So this is also tells you something that if you have, for example, introduced some hedges in your portfolio, and there is some kind of extreme scenario in the market, then it may happen that your VAR will not improve. It can actually deteriorate. So this is important to keep in mind, and this may have to do with the sub-additivity. Of course, in that case, you should also look at different measures, like, for example, expected shortfall, that we explain later, and expected shortfall satisfies this condition. So then you would have a better understanding. So if your VAR would increase, but shortfall decreases, while diversifying or hedging, then it will give you also signal that something is happening in your portfolio, then you will know what is the reason for it. The second requirement for the coherent measure is that if x is smaller or equal y, then the measures, actually you see the kind of opposite, you have to, it's a little bit maybe confusing. So if x is smaller or equal y, then the risk measure of x should be bigger or equal of y. And this is where it comes from. So let's take a look. This measure implies that if we have a value of an asset x, which is less or equal the value of an asset y, then the risk of x should be greater than the risk of y. In other words, the risk of good assets should be less of inferior assets. So we are looking from perspective of value. So if something has a, say, if y is worth million and x is worth 10,000, then we would say there is a less risk associated with y, because from million, it may not decrease to zero as fast as x, which is worth x, so 10,000 in this case. Of course, you may doubt whether it is indeed the case, because, for example, you would say, what if your y has much more uncertainty, volatility in the valuation? So suppose you are deep in the money, but there is a huge amount of risks associated with that. Indeed, that's the case. So this is why you should look at the multiple measures to quantify if this is the case. But this is the definition of the monotonicity with respect to coherent risk measures. We have a few more. Positive homogeneity. So this essentially is a simple case. So we have a times x, and we take a outside of a risk measure. This means that we are not sensitive to a unit of measurement. So whether it's in dollars or euros, whatever we choose, this you can always scale your VAR, and then you can represent your risks in dollars or euros. That will not be affected by particular unit or currency you have shown your risk. Of course, if you talk about stochastic effects, that would not be the case, because then we are not talking about A, we are talking about the risk factor, which has to be included inside. So this is more for the, let's say, checking with a 2 days VAR. If you calculate it, if you transfer to different currency in 2 days spot, then this is then it's equivalent. And transaction invariance. So this is also another one. So we have raw plus A, and we have here raw of x minus A. This is interesting composition, and this has to do with the cash amounts. So implying that this equality implies that if we have a cash amount A is added to an asset, it offsets the corresponding risk associated with X. And this has to do with this fact I told you about this distribution, that if we have our, let's say, P&L profile for our asset, if we add cash, essentially the distribution will move to the right. So this will impact the cash will, let's say, will be moving the distribution into positive environment. So you can always add cash to your portfolio to reduce VAR. Essentially, this is what it means. As I already have mentioned, VAR does not satisfy sub-additivity. And what are the variations? What are the issues with that? So if we have a VAR measure which doesn't satisfy sub-additivity, this also means that we are in this case scenario, let's say, very unlikely. However, it can happen that sub-additivity for VAR doesn't hold. Then, for example, we have a situation when a financial institution is employing a VAR measure without realizing it validates it. So this is basic case. So if we apply VAR, but we don't realize that it validates the sub-additivity, for example, using VAR to risk investment choices or imposes limit on traders. So for example, you would see your VAR increases, however, you would expect to decrease. This means that you would limit your trader to perform a trade. However, you would expect logically that you are incorporating offsetting trade, so that should reduce your VAR. And of course, that may have to do with this sub-additivity condition. So sub-additivity tells you that by including, let's say, hedges you should remove your risk, should be having offsetting or the netting effects. And because VAR doesn't always hold this, that may give you a rise to wrong interpretations that may actually affect the trading line, because you can impose some constraint on the traders, on trades, that actually could help you in the risk management. However, because the VAR measure gave you wrong signals, you may be reacting in a opposite side. In this case, the financial institution is likely to assume too much risk or not hedge the risk when it's needed. So this is obviously the consequence if you are applying those measure and this condition of sub-additivity is not satisfied. I would like to stress again that however this measure is not satisfied, VAR measure is still popular and is used in the industry. However, like I already mentioned, never rely on a single measure. Also look at different measures, like for example, expected shortfalls that I will discuss in the next slides. A most popular coherent risk measure is the so-called expected shortfall. It is actually something that a measure that relies on a VAR that is not coherent. So let us take a look. In the previous previous part, we discussed the VAR. VAR, so if we have distribution of our profit and losses, so for example, this is our distribution, it's profits, of course we may have losses there, let's say. So VAR of this level, let's say alpha here, so let's call it X here. This will be our VAR, so this is this quantile that here we have, let's say 95, or we have a confidence that our losses will be less than this level X. So this is standard VAR, and here, so we have here, we have 1 minus alpha, and this amount, the mass probability on the left-hand side is alpha. So for example, this is 5%, this is 95%. So what actually, so VAR is always about indicating this point where we have 95% confidence and we have a remaining 5% confidence, or 1 minus alpha and alpha. And of course, VAR is not really indicative. What are the worst case scenarios? It only tells us about the level where we feel comfortable, what are the, let's say, most likely losses we may have, but it doesn't tell us, okay, what is actually the loss? What if the loss was here? So as a risk manager, you may not want to, for example, have losses which are here, here, or here, and then only that, okay, fine, that's only 5% chance we could be there, but still, if a loss there, it's huge, that would essentially destroy your financial institution. So possibly, you definitely don't want to have that kind of responsibility. So of course, what you want to do, you want to minimize also those tail risks. And what is the definition of expected shortfall? Expected shortfall, first of all, is looking at this VAR. So you see that VAR here is an input for expected shortfall. So we are looking at variable X, so this is our P&L, which is smaller than VAR. So we are actually looking at this area here on the left-hand side. And what we do, we take the expectation under the condition that X is there. So you see, we are not looking at this part at all. We are only looking at this, if this is P&L, on the left-hand side, and then we take expectation. So for example, expectation is here. So you see that if we take all this, let's say, tail events of all the, let's say, the losses we potentially could have, we are not only looking at the, let's say, the smallest loss from this interval, but we are looking at the average loss given that the losses are exceeding the level alpha. Yeah? So this is the level X, or the level determined by VAR. And then we take expectation. So you see from the risk management perspective, expected shortfall will be always more conservative than VAR, because VAR is only giving you a point. Expected shortfall takes the expectation of all these losses that could be bigger than X. So of course, obviously, this will be always larger in absolute sense, because it's a negative, larger than X. So this is essentially the definition of expected shortfall. So this means that if you would like to calculate this expected shortfall, first calculate VAR, get the limit point where the losses exceeding that level, and then take the vector of all those losses and essentially just calculate average of that. to calculate average of X, given that samples you're taking in your computation are less or equal to the value of VAR, which is determined at this point. And this is it. So this is essentially expected shortfall. What is important here, that expected shortfall really concentrates on the tail. So you see this distribution here really depends, it's a tail dependent. We are looking at the tail of those risks. And then we calculate expectation. Of course, you could also say, let's look at the quantile of this quantile. So we take this one and we look at the quantile of this distribution, of the conditional distribution, even could be further. But of course, this is already, let's say, improvement against VAR, because we are looking at the tail risk. Of course, you can do many different things. However, always the question is, what type of data have you used to calculate your VAR? So for example, if your data, historical data you have used in your simulation, it's a data where there was no market fluctuations, there was low risks, then obviously if you go to this direction, you indeed becoming more conservative. But what is the point then of looking at the quantile of this conditional X if there's no really events happening in that tail? So it is important that if you apply something, if you look at the market data, you always have to look at it carefully, what type of data you have and how many of those data events you have. Because could be that here there are only few, if it's, I think, 100, if we have 100 observations, alpha is 5%, so it's 5 events will be only in this area. So if you'll be looking at the quantile of that, doesn't really make sense. I guess it's very discussable, because we are looking at maybe one observation could strongly impact the overall results. And I'm not sure whether you, as the risk manager, would like to, from day to day, dramatically change your view on the risk profiles of portfolio. So you have to be also pragmatic. You should choose measures which are realistic to some extent. And most important, don't be too extreme, because maybe the data you're using, first of all, is not reliable, and maybe it's just too few data points to really make a big statement about your risk management policy.